Good afternoon, everyone. My name is Christopher Cahill. We're going to be doing our lunchtime webinar series today here for the month of July 2021 on understanding how insurance strategies can complement your retirement. Thank you for taking the time to join us. We really appreciate it, and please know that we'll be posting this to our website after in the event that you need to jump off for any reason. I'm going to be as efficient with our time as I possibly can. So here you see my smiling face, Christopher Cahill. I'm a partner at 12 Points Wealth Management, as I said. I run the Family Office Services Group, and I've got over 20 years of experience working with affluent families, particularly lawyers, law firms, C-suite executives, business owners, etc., on all manner of financial, estate, and philanthropic planning. The big question that many people have as it relates to retirement funding is, will I have enough to live on and live that life that I've dreamed of? And what we're seeing today, sadly, is it's difficult to amass the amount of assets that one needs in order to achieve your objectives long-term through traditional funding vehicles, i.e. IRAs and 401ks. Tax deferral is a wonderful thing, certainly. So as we all know, putting money into an IRA or 401k provides you with that tax-deferred growth opportunity, more assets in the future, because you don't have that parasitical drag of taxes, which is illustrated here in this slide. So as we see in this instance here, if you were to contribute assets, $10,000 investment over 30 years into a taxable investment that was coming off at an income tax rate of around 40%, that asset would only grow to about $28,000. If we had capital gains taxes applied to it, over that 30 years, it would be $40,000. But if we were in a tax-deferred environment, an IRA, 401k, et cetera, at 6% a year, you're going to have substantially more. So $57,000 based upon this scenario here. So really important to pay attention to tax-deferred growth. And the trick is how to find it, how to take advantage of it, and what to do when you max out those available options that you have through your employer and personally. So taxes impact growth, distributions, benefits, and more. So will you have less to invest due to taxes? Most likely, right? So let's consider the taxes may have the biggest impact on your financial planning now and into the future. And this is particularly timely, I think, in light of where we are in the legislative cycle, the political cycle, just the reality of where we are in today's day and age. Most commentators feel that taxes are going to be going up. So we need to be cognizant of that. We need to be savvy about how we invest, how we plan in order to take advantage of our available options as it relates to savings. So here we have the impact of taxes. So the top federal bracket currently is 37%. We have capital gains rates of 20%. These things are potentially going to be going up. State tax rates depends upon where you are. Massachusetts is, used to be called Taxachusetts for a reason. We're no longer as bad as we were, but 5+% of tax of adjusted gross income. And of course, we've got Medicare payroll tax and net investment income taxes, both adding to the tax bite. So certainly we're all aware that taxes are going to make a huge impact on our future retirement capabilities. As I just described here a moment ago, the bad news is the taxes are going up. So not simply President Biden, we're looking at, the reality is that we're going to have increased taxes on what I would suspect all fronts, both income taxes, capital gains taxes, estate taxes. We may also see reduced or eliminated deductions otherwise. One big thing that's on the agenda currently is removing the step up in basis that happens at death for assets in excess of $1 million. Those things are really have been sacrosanct in the tax code and have been really important for planners such as myself. Changes to those rules and regs are going to impact people. And they're going to be it's going to be a challenge. So really trying to find places where we can invest and be smart with tax deferral. One of the best places to save, where most people save, is through qualified plans, right? Most of us have access to a 401k now through our employers, 403b if we're in a nonprofit arena. Unfortunately, the limitations on contributions to these plans, income restrictions, prevent high income earners from really doing substantial planning. So the reality is that you cap out at $58,000 a year, give or take. I think it is currently in the arena for 401ks. If you're making $500,000 a year, that's approximately 10% of your savings, 10% of your comp being allocated to savings. It's not going to be enough to maintain the standard of living that you're probably aspiring to in retirement. So, what are we going to do, right? We're going to take advantage of the plans. Personal contributions are $19,500 individually into a 401k, 403b. You're going to also max out your IRA contributions. There's catch-up provisions available for each of these things as well. And we're going to make sure that we're maximizing all available contributions to these plans. But at some point, we're going to hit a wall where we can't contribute anymore. One thing that we need to really be cognizant of is that retirement doesn't necessarily mean that you're going to be in a lower tax bracket. Often that's a misconception that I see many clients and folks that I speak to assume on a regular basis. You're going to have accumulated significant wealth over time, and you're going to be taking those distributions from your qualified plans and your IRAs. More likely than not, those assets will be taxable to you, and they're going to continue to keep you in a high bracket. So the idea of you going down to the lowest bracket is probably not going to be the case. So you really want to pay attention to that. Additional considerations on taxes in retirement. You're going to have 85% of your Social Security benefits subject to income taxes. If your income exceeds certain thresholds, standard Medicare Part B premiums, $144, but could be up to almost $500 depending upon your income. That's going to make an impact as well. So really what we're going to take a moment here and look at is the available options for you for saving, right? So investment option A is, pre-tax. These are the 401ks, the profit sharing plans, IRAs that we just discussed, qualified plans. Typically funded using pre-tax dollars through your employer or personally in the world of the IRAs. The growth is tax deferred, which is wonderful. But of course, the money comes out as taxable, right? Under this scenario here. So taxed as ordinary income, and you have to take the distributions after 59.5, otherwise you're going to get a 10% penalty. The required minimum distribution date has been moved to age 72. There's talk about that being pushed back even later, which would be wonderful for planning purposes. But for now, just know that it's age 72. So what's the benefit of saving pre-tax? You're going to get pre-tax contributions, and you're going to get the potential for employer contributions and matches. Unfortunately, you have limited access to accounts without penalties, and distributions are taxable. So this is the world of the pre-tax savings vehicles, one that most of you, I'm sure, on this call today are well acquainted with. Taxable accounts, these would be, an investment account that's got mutual funds, stocks, bonds, whatever variety of investment or flavor you'd like to have. They're simply funded with assets that you have that have already been taxed, after-tax money. Now, dividends and capital gains taxes are going to be assessed and taxed depending upon the particulars of the investments that you have. And of course, capital gains taxes are going to be assessed on the growth during distribution phase too. So there's no limitations here. So this is the good news. And the accounts are completely liquid and accessible. So you don't have those penalties of the 59.5. And The downside to it, of course, is that you're going to be paying the toll all the way along. You're going to be paying on your capital gains taxes. You're going to be paying taxes on dividends, etc. So that's going to impact the overall growth, right? So certainly a great option to be funding, but not the best option from our perspective. Now we have things that we like to call tax-advantaged investments. So these would be, municipal bonds. We're probably aware that those are income tax-free and can be state income tax-free depending upon where the bond is located and where you're located. But really what the two topics that we're going to touch on here most important are the Roth IRAs. These assets grow tax-free, and cash value life insurance, which we're going to talk a little bit more about as we go forward here today. So in each instance, these things are funded with after-tax money. The growth is tax-deferred, which is wonderful. Distributions are tax-free from Roth IRAs. You can't get better than tax-free, folks. So that's really, really important to pay attention to. And that we do have the age 59 and a half limitations in the Roth IRAs here as well. There are income limitations with contributing directly to Roth IRAs. And there are penalties, as I said, in the event that you try to take the money out earlier. So there are mechanisms to get around the income tax limitations through Roth conversions. Not going to get too deep in the weeds on that today, but know that for many of our affluent clients, we are doing annual contributions, non-deductible contributions to IRAs, and doing Roth conversions for them on those assets that have been contributed, because we can contribute and make those conversions without having an income limitation. So we're going to now take and pivot a little bit and talk about tax diversification. So, as we just reviewed, you have tax deferred options, you have taxable options, and you have tax-free options or tax-advantaged options. In an ideal world, you'd have some assets in each one of those buckets, which would then permit you to be smart as to where the retirement income is going to come from, where you're going to be pulling from. So this is what we talk about when we're talking about tax diversification. So deciding where to invest is going to affect retirement savings, and diversifying the income tax treatment of investments can reduce the overall tax bite in retirement, which again means more for you. So that's a really huge component. So we're going to take a look at that here. So assume for a moment that you were going to take $100,000 a year out of a portfolio that is purely 401k assets. So these are now going to be subject to ordinary income tax when you take the distribution. So for this illustration, we're saying $120,000 is going to put you in a 35% bracket, hypothetically. Assuming that that's the case, you end up with net $78,000 of income. Might not be what you were looking for, right? So if you're looking to get closer to that 120, how could you do that differently? Well, if you're fortunate enough to have assets that you saved in different buckets, 401k, capital gains type assets, and then tax-free assets, here in the illustration is using a life insurance policy. You could take $40,000 from the 401k, that would net down to 26. The mutual fund, assuming capital gains rates applied, would net down to 34 after take 40 to 34. And then the life insurance in that tax advantage, tax-free bucket would come 40 to 40. So you could increase your income pretty substantially to 100,000 under this scenario here. So this is really what we're talking about in the world of tax diversification. It's just being smart as it relates to where you take the money from. The last thing that you'd want to do is pull money from a 401k when you're bumping up against a new bracket, when you could have access to tax-free assets, either in the form of a Roth or in the form of a life insurance policy with cash value in it. So we're going to look a little bit more at that now, how life insurance can provide and be a flexible tool that can help you in many ways here. So we're going to talk about the benefits of life insurance, obviously, we know, can help your loved ones maintain their current lifestyle, pay off mortgages, defray state and income tax and the state taxes in the event of your passing. So this is all for your loved ones. We all know why we have life insurance. That's the primary focus for most policies. There's oftentimes a supplemental and secondary purpose, though. It can help you and your spouse with supplemental retirement income. So what we're going to talk about now is what that looks like, right? One of the things to keep in mind is that insurance in retirement planning is really helpful because you can get income tax-free death benefits. You can get tax-deferred growth on the cash value, and you can get income tax advantage distributions. So what does that mean? So if you have a permanent insurance policy with cash value that's accumulated, you can take withdrawals from the cash value up to the basis, meaning the amount that you've invested in the contract. Those withdrawals are tax-free. So that's a really wonderful vehicle to help supplement your retirement. And after that, once you get to basis, you can switch to loans and take loans against the cash value, in which point those loans are also tax-free. So really a flexible vehicle. This illustration here shows how most people typically buy life insurance. They really want to buy the most death benefit and focus on the least amount of cash value. If you're really looking purely for survivor benefits and needs, this is how you would design this contract. If you are, however, looking to maximize cash value in retirement and ability to fund your retirement, you'd want to have as small a death benefit as you can, which would, for the amount of money invested in the policy, the premiums paid, would over time increase the cash value. And as you see, would start hockey sticking it up and to the right. This is what you'd want, is that cash value to be able to grow, be able to take those withdrawals, as I just said, based upon up to the basis of the contract, then be able to take policy loans throughout the balance of your lifetime into retirement. That's the beauty of and flexibility of a permanent life insurance policy that's properly funded. How would it work? Basically, you pay your premiums. They go to cover the cost of the policy. Anything excess over the cash needed to create to cover the cost of the policy is going to create cash value. That cash value will accumulate and grow tax deferred over here. If, heaven forbid, you predecease and die before you start taking the cash value, you're going to have a death benefit for your heirs. So that's bad news, good news. The accumulated cash value, as I said, will continue to grow tax deferred. When you retire, you can access this cash value in the form of those withdrawals and tax advantage loans that we just described. So this is giving you a new tool in the toolbox to add to those other assets that you obviously already have, most likely, which is your 401ks, your IRAs, and taxable accounts. So in this sort of strategy, you're going to probably be the owner of the policy. You'll be the insured. You're going to pay the premiums. Couldn't pay it any way you like. Most people tend to quick pay these, which means you pay it for 15 to 20 years. And again, you want to structure the policy so that you get the most premium payments in early years, which allows the cash value to grow. As I said before, you'd be able to withdraw the cash value up to basis, income tax free, and you can take loans thereafter, which would also be tax free. So this is how these things are structured. There's a whole world of different products available. We're going to just touch on them ever so briefly here today. We could have a thing called an indexed universal life contract. This uses credited rates to adjust for increased or decreased market indices. So it's basically a point-to-point sort of scenario based upon how the market does, assuming that the underlying index that you're targeted to in this contract is, say, the S&P 500. If the S&P 500 went up by a dramatic amount through the year, you're going to get a portion of that growth. If it goes down by a dramatic amount, you're likely going to have a floor, meaning a 1 or a 0 sort of return, which is really attractive. in order to get away from all of the downside that you'd have in a normal market environment, you're going to give up, as I said, the upside, and that's typically what's referred to here as the cap. So, you're not going to get a full 20% up in a 20% year. You're likely going to get 10 or 12%. I would submit to you that avoiding the precipitous downs makes this a particularly attractive sort of strategy, however. Variable universal life, here, you think of this akin to your 401k, where you have a whole suite of investment options available to you. You can pick and choose from them and develop an asset allocation, invest the cash value, and watch it grow. You can also watch it go down because it does have market risk and it doesn't have that floor that I just described in the indexed universal life. So, this is something to pay attention to for sure. And then current assumption universal life, this is where the investment in the policy is really going to be dependent upon the returns of the insurance company, how they do. So you're not going to really be able to impact that. As a result, there's going to be a lot less risk associated with this during market volatility. And, this is something that's probably the most conservative of these contracts that we just reviewed here. So we're going to take a look here at an example of using indexed universal life to fund and supplement retirement, right? So assume for a moment that you're 45 years old, that you have additional capital that you can invest, and that you've maxed out your IRA and that your 401k has been funded. Another option might be to allocate some money to a insurance policy here to help fund retirement. So in this instance, we've got a 45-year-old that's contributing $50,000 a year for a period of 20 years. So over 20 years, he'll have paid in $1 million into the contract. Over time, that will have generated about $1.5 million of net cash value. Throughout that time period, the death benefit would have grown to about $3.3 million. So if he were to pass away here, the family would inherit that amount of assets, tax-free. The net cash value is now available for withdrawal, however, in retirement. So here, what we've illustrated is at age 65, when he's clocked in, got his gold watch from the company, and off he goes, what we're going to do is begin pulling cash value to subsidize the living expenses, for this individual. So we're assuming a 6.2% hypothetical rate. We can question that number, but for illustrative purposes, that's what we're showing. So what we see here over the next 20 years is $118,000 a year of distributions coming out. That's pretty hefty. So from my perspective, this is a really wonderful way to turbocharge and provide $2.3 million of combined tax-free income for the cost of $1 million over 20 years. So this is really powerful stuff and a good basic illustration of the concept here. Now, we talked a moment ago about market volatility, and we all lived through that recently back in March and April of last year. The 2-month bear market that we had, as crazy as that is, but it's a fact. But it did tend to get people focused again on the realities of risk, right? So many people hadn't seen their portfolios go down for a while, and then they did, and that, tended to focus the mind for many of our clients. So the importance is paying attention to market volatility and how to take withdrawals from your retirement accounts in a thoughtful way so that you're not locking in losses. Many people don't have the situation set up as well as they should, where they would have tax deferred, taxable, and tax advantaged assets. But assume that you did for a moment. What we'd see is something that looks a little bit like this next series of slides. So what we're really going to try to do again here is give you, show you the benefit of combining withdrawals from your retirement accounts and withdrawals from the life insurance policy in order to subsidize your lifestyle and permit the assets to recover, the taxable or tax-deferred assets to recover after a downturn. So next couple of slides are really illustrative of that, I think. So for argument's sake, let's assume for a moment that you have a starting balance of $1 million in a 401k. You're now in retirement at age 65, and the objective is to take a distribution of about $70,000 a year from your retirement account. For purposes of this illustration here, we've assumed that there are 5 periods where the market is returning a negative return over the next 20-year period. Okay, so for this slide that you'll see here, what we're seeing is the current beginning balance of the account, the 401k, in this instance here, the annual desired withdrawal increasing with inflation, the post-withdrawal balance, and then the worst possible result, which is a big negative or 2, in this instance, right at the beginning of retirement. That can really cripple an account, because when you look at it, we've now gone $1 million to 930. The 930 catches a negative 14%, and you're down to 793. You take your 70 out, you're at 722, but you capture negative 26. Now you're down to 531. Your account's largely cut in half now based upon 2 negative years back to back and these withdrawals. So even with the rebound in the years 3 and 4, this account is pretty much run down to $440,000 out at age 85. That's not a result that anybody would be excited about. So this shows you the impact of turbulence and volatility in the markets to a traditional withdrawal structure. Okay, really important to see that. What we see next is, if we assume in this instance that Tom had the advantage of purchasing a life insurance policy with cash value to protect his family when he was in his 40s, here, instead of just relying upon the 401k, we can take strategically timed withdrawals and loans from the life insurance policy in those years following market losses and allow the portfolio to recover. That's going to make a materially beneficial impact on the net. And you're going to see that here in a moment. So on the left side is the illustration that we just went over, $70,000 a year. In the first year, 930 balance, negative 14%. Now you ride into the year 2 and you say, wow, I've only got 793 here to start the year. I don't think I want to take another 70 from that this year, because what happens if I get another negative year? So instead, in this illustration, we take 50 from the life insurance policy. Why 50? Because it's not subject to tax, and that's the net amount of the 70 at a 28% tax bracket. So what we do for the next 2 years, in years 2 and 3, is take the money from the life insurance policy, allowing the 401k tax-deferred account to continue to grow. As you'll see, the account's recovered pretty nicely during this time period and grown in years 4 and in years 5 and 6, where it's now negative again. We take that next distribution from the life insurance policy, so on and so forth. At the end of the day, at age 85, we've got $3,587,000 of cash in the 401k, which is substantially more than it would have been under this scenario back here that we just saw. So the sequencing of returns and the ability to take assets from a tax-advantaged vehicle, whether it be in this instance here, it's life insurance. Theoretically, it could be the Roth, but I think the life insurance vehicle is what we're illustrating here, really shows the impact of that. So this is powerful stuff from my perspective. It's giving you the flexibility as the consumer to dictate when and where you take money from. You can be thoughtful, you can time it, and in doing so, you can end up with a better result potentially out into the future. So that's what this slide is really illustrating here. So we're going to spend a minute and talk about the advantages and disadvantages of these sort of strategies. So, the advantage of this design is that it doesn't impact qualified or non-qualified plans. You can continue to fund your 401ks, your cash balance plans, whatever you may be doing with your company. It's going to provide an income tax-free death benefit in the form of life insurance. That's a wonderful component. Income tax-free withdrawals of cash value up to cost basis. That's huge. There's no limit on the contributions, except that you wouldn't want to create what's called a modified endowment contract. It's a little bit above and beyond the scope of this presentation here today, but just know that you'd want the policy to remain what we call life insurance, not become a MEC. You wouldn't have any required minimum distributions like you would in a 401k or an IRA. You'd get tax-free growth potential on the cash value. And you can get some valuable riders on these policies as well. You could get a long-term care rider that could provide a benefit for you in the event that there was a long-term care need. And you have a lot of products to choose from as well. So there's really a whole bunch of available options out there that could be right for your potential family fact pattern, your risk and reward appetite. Of course, there's disadvantages as well. You'd have to provide medical evidence in order to show evidence of insurability to obtain the policy. You would not get tax deductibility of premiums paid. That's just the way that goes. That's fine. From my perspective, what you're getting is better, more than enough, truly. You could have income taxation of gains if the policy lapses or is surrendered, or if it becomes a modified endowment contract. So if you start down this path and you start taking distributions and you get to a point where you've used your distribution, you've used up the withdrawals, and now you're into loans. If the policy lapses with loans, that loan will become taxable income to you in the form of forgiveness of indebtedness. That's not a good result. So I would submit to you that you really wouldn't want to have a policy lapse with a loan. Or if you lapsed a policy and there were gains in the contract, that would similarly be taxable. And withdrawals from MECs are also taxable. So again, another reason that you really wouldn't want to do that. So the withdrawals and loans decrease the death benefit. That should be pretty obvious. I'm not sure that we talked about that, but if they do. And the insurance costs can reduce the funds available for withdrawal in the future, right? So that's why, if you'll recall that one slide that showed having as little death benefit as possible up front and letting the cash value grow, that's really what you want to do, because less death benefit means less insurance costs, which means more opportunity for growth. So before you move forward with this sort of strategy, or anything for that matter, you really want to make sure that you have sufficiently liquid assets to support income and expenses before implementing an insurance solution like this. You only want to use assets that will not be needed for living expenses during your lifetime, right? You want to be able to allocate things that are really discretionary at this point. If your financial and legacy strategy situation changes, you may no longer make premium payment, and you can no longer make them. Your desired results may not be achieved. So, obviously, if you fail to make the premium payments, the policy is not going to perform as it's been illustrated. You really, life insurance death benefit, in that instance, if the policy terminates, the death benefit terminates. And the reality is as well that as with any of these sorts of things, you want to consult with your tax and legal advisors. There's a lot to implement one of these programs effectively. It's not rocket science, but it does require coordination. we're here to help any way, shape, or form that we can. And know that you can find me here at chris@12points.com. Email me if you have any interest. I'm happy to speak to you. Or you can call 508-934-9409 anytime, ready to talk. And I appreciate your time today. We do like to do these in a half an hour, so I'm just a bit over. But thank you all for joining. I appreciate it. And stay tuned for our upcoming event in August, Raising Financially Fit Children with Deb Cardiser. Thanks so much. Bye-bye.